այսօր մի քիչ ուրիշ էպիզոդ է, այսօր սուպեր հյուրուն ենք, ուրեմն Ալեքսը, որ venture capitalist է։
We have approximately $3 billion under management now.
You basically invested in Podcastle, Krisp, BigStory. So give a little bit background on that. Why?
I never thought about saying I will go to Armenia and look for companies over there. I feel that there is unique opportunity in specifically Armenian ecosystem.
What's your expectation over next 10 years?
The good performance of the fund, if this $10 million becomes 30 million or more. You as a founder should be much more focused on choosing a person with whom you want to work rather than a firm.
Did you have a clue in the investment memo that this company is going to be like $40 billion company at some point?
And if someone tells you, okay, I believed in that, I think they're bullshitting you. Sorry. Direct outreach to VCs. If you are a founder, if you want to reach out, just forget about it. It's a waste of your time.
Both, it's pretty inefficient process from both sides, I guess.
It's a marriage between a founder and a VC.
Can you become a billionaire?
Okay. Oh, if Krisp and Podcastle would deliver
$100 million?
Big.
What Alex, just tell us.
The number I think needs to be north of $50 billion value for each of the companies. Yeah.
You got it. Բարի գալուստ էպիզոդ 19-ը, այսօր մի քիչ ուրիշ էպիզոդ է, այսօր մենք սուպեր հյուրուն ենք, ուրեմն Ալեքսը, որ venture capitalist է, այսօր ուրեմն առաջին անգամ անգլերեն է լինելու podcast-ը, so եթե չեք հասկանում անգլերեն, ոնց որ good luck, բանով կթարգմանենք, subtitle-ներով, բայց So that was the sort of the opening, Alex. Welcome, Alex, to the podcast.
Thanks for having me. Unfortunately, I cannot do the same in Armenian. Sorry for that, but I will practice for that.
Well, you know what? It's been like 3 years, and you haven't made any progress on that side. Shame.
I accumulate the knowledge.
Yeah, I was just saying that this is going to be the first time we are doing it in English. And if people don't understand English, good luck, right? They have to. If they are in this industry. Well, cool. So as we were chatting, like the focus is, let's talk about venture capital 101, basically the basics, and then we will maybe dig more into more advanced topics, right? But what just as an introduction to Alex, and Alex, you can sort of add more color to this. But Alex is a partner at VC called RTP Global. RTP is an international VC firm headquartered in London, and they have multiple offices around the world. They have offices in the US, India, in Europe, and so on. And so they invest globally, mostly focusing in US, India, and Europe. So, and what makes our Alex particularly very special is that he is an investor at Krisp, and also investor at Podcastle, and also investor in BigStory. So we are very, very he has a very unique place in our heart. So that's why we are super excited to host you. Welcome again.
Great. Yes. Thanks for having me. Maybe some details that would be interesting for the people. I started in VC almost 16 years back, and throughout the journey with RTP, and always was an RTP. That's the only place. And around 2011, we started to build our international expansion, and together with my partners, we have been the one who brought RTP to Europe and India specifically, and Southeast Asia, and learned a lot of experiences, obviously, with that. The market was very different back then. It's very different every 3 or 4 years. Just to add a bit more flavor for the audience, RTP is a platform that we have approximately $3 billion under management now, over 110 companies, evenly spread more or less between US, Europe, and Asia. And some of the companies you might know, other than the ones that Davit obviously mentioned, were the first investor in a company called Datadog, now a very big business. Were one of the first investors in a company called Delivery Hero. Were one of the first investors in a company called SumUp. And those are obviously the examples that are, I think, true to VC in a sense of what VC should represent: high risk, high return, which we will talk about more today.
Very cool. Yerevan, seems you have something to ask.
No, I just wanted to ask, like, what are the chances that RTP would invest in 2 Armenian companies? Like, and what made you basically make this decision and invest both in Krisp and Podcastle at the same time? I think we spent a lot of time talking about this, but yeah, I think audience will be interested. Like, you basically invested in Podcastle, Krisp, BigStory. So give a little bit background on that. Why you came up with that?
Yes. Look, I think one of the things that is quite important to understand generally for the founders, and talking about VC, every VC firm has its own rules, has its own focus, and has its own frameworks on how they do things. Yeah. Specifically, I think when it comes to RTP, we were very opportunistic, always looking into markets outside of our core focus. So our expansion was a big driver on overall growth of the platform, and we were always open-minded with regards to looking into opportunities, and specifically into opportunities where you can leverage certain inefficiencies of the market. And inefficiencies of the market can be quality of talent versus price, knowledge, concentration of people, or something else. So for me, I never thought about saying I will go to Armenia and look for companies over there. I was thinking more, what are the interesting companies that are fit for us? And then ultimately, it's a coincidence of events that led me to first invest and us to invest in Krisp, and later on to invest in Podcastle. And this coincidence of event, I think, is everything that more or less the VC do. Yeah, because you meet with different people. Because in most of the cases, VC again is a business of taking a large number of risks and a large number of failure. Maybe let me just take a step here because it will be important to understand. So, in the portfolio, you build a portfolio of, let's say, 10 companies. 6 of these companies will go out of business. And maybe 2 of these companies would return the total amount that you invested in them. So if you invested $1 million, they will return $1 million. There will be maybe 1 company that returns 3 to 5 times the size of your investment. But ultimately, what you are trying to do, you are trying to find and build a portfolio that will have this outlier that will make it possible for you to return multiple amounts of the total capital. And now I'm not talking the capital of any specific investment, but the overall of the pool of the capital that you have. And this is what makes the model so interesting, so exciting. If you have a chance to pick the winner or multiple winners, then obviously you have a very interesting financial performance. But for me, when I met
Alex, sorry for the interruption. Just for the clarification purposes, when you're saying like a multiplier of the fund, let's say you have $3 billion under management. What's your expectation over next 10 years? Are you going to have like $6 billion under management, or $10 billion, or I mean a return, or like 30 billion?
I would put it this way. When the fund started back in 2001, it started with 1 to 2 million of initial capital. And this 1 to 2 million initial capital over the course of 25 years became 3 billion. Now, 3 billion is just the total assets that we have. So it's spread across different funds. And then we go into a bit of the details there. But what is good and what's bad? Let's try to make things very simple. If I have a fund and let's say it is $10 million, the good performance of the fund if this $10 million becomes 30 million or more. Yeah.
Over what
And
period?
remember, we are talking on the horizon of 10 years plus. So the average duration of the fund is 10 to 12 million. So that's kind of in a very simplified way how we're thinking about good and bad. Yeah. Obviously, you see the examples of the funds doing much more than that. So our first fund in US that was launched in 2011, that was the fund that invested in Datadog. Datadog alone produced more than 2 billion position, and the fund was 50 million. Yeah, so you can basically have a sense of that. There is a lot of details in this again because it's all about timing, not only the absolute amount that 50 becomes 2 billion, but also over what period of time. But those are smaller details. So look, our goal is to say, if we now swap to a more maybe standardized metric, which will allow to unify everything, we are looking to generate more than 30% IRR on the capital that we invest. So IRR meaning the interest on the compounded interest should be above 30% a year on the capital that we will put into the game. Which I think, again, for entrepreneurs, it doesn't really matter. What matters for the entrepreneurs, and then I will come back to the question around Armenian company, is the following. When you deal with the venture, and I'm a partner that looking into your business, yes, I'm working with you, I'm working with your company, but I'm thinking in the terms of portfolio. And portfolio means I have some number of companies that are part of the same fund. And when I'm looking about, I made an initial investment with you. I made a decision to invest in your company, and then we'll talk about how decisions are made. But the most fun part happens after it. How do I work with you? How much time I devote to you? And how much capital I can deploy into you? And this very much becomes a question of what is in my bag. Yeah. So what do I have in my bag, and how does the things rank in that bag, and how much opportunity I can give to each of them. And then interesting things start to happen. And this is very relevant, especially when we will be talking about the large funds, and I will touch on this in a second. But you need to understand, yes, you are unique, and this company is unique to you. But for every investor, you are one of the many companies in their portfolio, and ultimately they optimize for the success. And so ultimately, they don't optimize on the individual success necessarily, but on the success of the overall portfolio. And because of the profile of the investments that we are making, and we are talking here primarily being first investments, we are not talking about companies who are public, we are not talking about companies who are, let's say, several $1 billion. We are talking about the companies, let's say, that raising capital and value themselves, let's say, below 100 million. For the sake of simplicity, one can say below 200 million, it doesn't really matter. For these companies, this is still very high risk. And chances are that any individual company will not make it and will not create $1 billion, $2 billion, $5 million business is very, very high. And your partner, your investor would always evaluate what are your chances and how does this basically stack with the portfolio. And so what is important to understand that, just to finalize on this, that a lot of the decisions are driven not by individual company and your company that matters to you, but are driven by the overall picture that the fund is having in front of their eyes.
Does it mean that you have, let's say, weekly or monthly reviews where you have all the companies there and you have some understanding of how every company is doing, and then you dedicate your time and resources based on their performance? Like, is that like, I'm sure it's happening. I'm wondering, what's the cadence of that? Is it like weekly reviews, monthly reviews, every quarter, right?
Yeah, cadence and the detailization of the reviews can be very different. We do, in RTP, we do quarterly reviews where we try to put all the portfolio on the same more or less grid and look into how basically, and normalize it and try to see, okay, how are things moving over there, yeah? the time element is a bit tricky, because I think building a company or working with a company over the course of this journey is not really a consistent time allocation. It spikes. Yeah. So when the company is fundraising, or when the company is having some troubles, or when something else happens, like there are very high spikes. But overall, if you normalize over a long enough period of time, you will see, and you will obviously try to dedicate the resources to the ones that are more higher performing. And again, I think this is for everyone building a company. The most important maybe takeaway from this part of our discussion is to understand that I'm a manager and I have responsibilities to my investors who gave me money. And overall, I am looking into the overall composition of what I have, because for this composition, I have a limited amount of money I can put. And I can make choices around where I'm putting them, especially when it comes for what we are calling follow-on investments, i.e. investments, not the initial investment I make in a company, but my investment number 2, number 3, number 4 over time. Let me just finalize answering the question on that Arto asked on Armenia. Look, through my conversations, and this is basically what happens a lot, and this is, I think, the interesting part about being in venture, is I started talking to Davit and Arto back in August or July 2020. And through talking to them, we obviously talked about the company, but we started talking about the ecosystem. And then it came very quickly, it came to me as a realization that I feel that there is unique opportunity in specifically Armenian ecosystem, and maybe another ecosystem, but let's talk about Armenian ecosystem here, driven by two things primarily. Number one is the quality of the technical talent, meaning that you can build high quality product, and connectivity of the ecosystem. And what I mean by connectivity in the ecosystem, I think this is the unique quality where the people are willing, and people, I mean entrepreneurs, are willing to share knowledge between them and help each other. And I think this is very powerful, because there are a lot of questions that entrepreneur needs to answer, especially in a relatively small market like Armenia. You have to build for the US or European market straight away. And when you have the opportunity to go to people who have already done it, talk to them, get their advice, and this is practical, I think this helps a lot, helps accelerate. And I felt this connectivity, which I didn't really see in many other places in the world. What's the alternative motion? Well, you probably, again, being in the ecosystem, it's not very trivial, but a lot of the ecosystems are cutthroat. Yeah. I would never open, I would never share, because we'll compete, and I increase your chances of getting there vis-a-vis decreasing my chances of getting to a successful result as an entrepreneur, and it's a very non-pleasant environment to be in. So that's what I saw. And then the puzzle started to shape. I was more curious, and then I got from Davit, I got connected to Arto Yeritsyan, and then it all started to be put in together as we continue to develop the thesis. But for me, it was always driven about these two things. The ability to build technical products at a much broader scale and with much more in-depth expertise, and the ability to leverage the whole network of the ecosystem to help you accelerate with them. So those were the two fundamental beliefs that I had that I believe continue to hold.
Alex, I also remember that when we first connected, you were working on a thesis on like voice and audio products, right? So that I think that's why Krisp caught your attention in the first place. Is my memory right? So you were actually as a partner in the VC. I think like one of your jobs is to always have a thesis on like where the world is going to go over time, and then go and try to find like interesting companies, and then maybe invest in this company. So from what I remember, we were in that sort of we have stumbled upon while you were doing that, while you were going through that process, correct?
Look, I think let's touch more on the point of how people in VC do their business, how they maybe look for companies, because this is something that has evolved a lot over the course of the last even 5 to 6 years. Look, the venture industry has grown enormously. A lot of people came into the business, and one of the questions that frankly, we as a VC firm or individual partners didn't ask ourselves, but this question now is every investor on the block is trying to understand what's my value proposition. What is my value proposition as an investor? Yeah, because again of the growth, because of the competition, the growth of the ecosystem, frankly, the decreased barriers of raising capital, this became a very big and pressing question for every firm. So look, I think there are very different ways that investors operate, and I would separate it into how individual investors operate or how firms operate. In our team, we have people who are very intuition driven, and you will see those people actually taking decisions in industries they have relatively little knowledge about, and they're very much focused on this notion of the founder. And I think the notion of the founder in our firm is the main North Star of what we are trying to discuss. And this is our core belief. So our core belief is that Datadog became Datadog because of the founder, and all of the other examples more or less stay within this thesis. There are firms that believe that the main thing is the market. And then if needed, you will have the founder that's good for a certain stage of the company, and then the founder will maybe go out, you put another founder, and the company will continue to grow. We are not in this type of. So, but from the type of the investor perspective, you have very people-driven investors. You have thesis-driven investors, people who try to build conviction and understanding on a certain topic or space, and how the space will develop into the future. And then they will say, okay, I want to focus on everything related with voice technologies. I would go deep into the details. I will create my network around it, and I will try to really identify myself what are the areas where some new big companies can be created. Yeah, that's the other kind of pattern of thinking. There are very data-driven people, but this is slightly more on a later stage when we're talking about companies that actually do have the data, and they will go and kind of look into all the data points and try to say, okay, this is good, this is bad, and this is what I believe in, and why the company is doing well. So there are different types. For the team in venture, one of the most important things is to understand how each individual member of the team is taking decisions, and they acknowledge what are the qualities that make certain person successful or not, and based on that try to accommodate his or her investment style. Yeah, but this is broadly the different types of the people that I think exist in venture, and I think it's very important. And then practical advice here to the founders would be from me the following: there are very different people in venture. I always say you as a founder should be much more focused on choosing a person with whom you want to work rather than a firm that you want to work. Or let's put it this way: you should not ignore either of this, but when you put the emphasis, I think it's very important to understand why this is the person that can help me as founder over the journey, what this person can bring, what can I rely on this person. This is always also a broader question: what resources can the person give to me? But I advise to the founders always to start with this rather than starting with the name of the specific firm, because the name hides a lot of the detail, which is much more personalized to you as a founder.
Alex, I have a question for you. So let's say 10 years ago when you invested in Datadog, I assume you wrote an investment memo, right? Did you have a clue in the investment memo that this company is going to be like $40 billion company at some point?
No, that's a very, very interesting question. So indeed, we have a memo, which we actually, last year, we sat down and discussed the initial memo for investment and the Datadog. It is very, very interesting, and it shows this whole concept of risk and the fact that it's impossible to see how the things will develop. So we invested in Datadog in 2012, if I'm not mistaken. This was a Series A investment. Series A back then was still below 5 million investments, so not 20 million like now. So it was below 5.
Current seed investment, right? I mean, would be considered more of like a seed investment.
Yes, in this world today, yes. What is interesting, back then it was a one product company. Today, I think they have, and I might be mistaken, but they have over 7 products that generate more than $500 million each today. Back then, one. The interesting part, all the product roadmap that they put in the initial deck, that they delivered upon. So it played out exactly like this. But answering your question, the most interesting thing is the following, and it's just our example. So we invested 2012. We were on the board of the company. In 2015, there was an additional investment round. So we're talking like 3.5 years post our investment. A good round. I think the valuation was around $1 billion or something like that. And the team sat down and produced a memo saying that we see potential in the company, but we probably think it will be $3 to $4 billion business. That's what they said, back then. In 2019, Datadog IPO'd at 7, now it's at 41. And ultimately, one can say, but guys, you had all the information because you were sitting there, you have been on the board, you have all this exposure to data. Look, ultimately, I think it takes a lot of time for the businesses to really unveil their full potential. An interesting pattern on these great businesses, and by great, let's say, I don't want to put a number, but the businesses that are really big, you would see how they have been able to accelerate innovation, growth, and so on and so forth over a long period of time. So you should not judge them on what they have done in 5, 7, or even 10 years. It took them more time to actually get to this unbelievable results. And if someone tells you, okay, I believed in that, I think they're bullshitting you. Sorry. It's impossible to see. It's impossible to see because it's dependent on your company, on the general trends that happen, on the overall macro, on 15 different things that have to come together for a company to become this type of the success, or this magnitude of success.
Yeah, but if you look to the portfolio of Y Combinator, 11% of their companies are unicorn plus. So maybe some people know how to get those like unicorns in the portfolio.
Look, you can index the full ecosystem, and then you will have 100% coverage. Yeah, I think what is important here is what is your model in terms of running a venture fund. Yeah. And this is also something that I think is quite important for entrepreneurs to understand. And don't overthink it. Just do this math. I think it's very simple. If I am a $100 million fund, based on the numbers that we discussed previously, I need to return $300 million to my investors. Let's just, for the simplicity's sake, a very simple exercise. Okay, and then the second exercise is the following. When we do our math, we say, what do we believe that every individual company alone, one company, can do this? So basically, and then when you are a $2 billion fund, do the same. Yeah, I need to deliver $6 billion to my investors, and this is why this is important, because when you will be talking to your investors, and when they will be asking you to do certain actions, certain decisions, take certain risks, They will always have this in their mind, in the background on their mind, that you are part of the portfolio and you're in your math, in their math. This is where you should go and what you should do. So if a fund with $1 billion under management or a $1 billion fund gives you, and with a great name, super great name, gives you a $2 million ticket, $2 million investors, is it good or bad? Well, different answers possible, but one of the things to consider is that I'm such a small fish in the pond that one time that the things are not going right, what is the likelihood that the people will continue to pay any attention to me? And I think people, entrepreneurs, they forget about it because they are too much driven by this initial charisma, coolness of something, vis-a-vis understanding what are the implications. What are the implications that it has for you and your company and the long-term behavior of your partner?
Alex, does it mean that if you're a small company, like you're starting, at every stage, your pre-seed, seed, Series A, Series B, Series C, and so on, you need to choose a fund that has the right amount of under management. Let's say you are pre-seed, it's better to work with funds that are small, and that's pre-seed is their focus. If you're raising in seed, it's better to actually work with or typically it's better to work with VCs that are like from 50 to 100 million in management, and then as you grow you start targeting a bigger funds. Is that sort of like a rule of thumb, or ignoring the exceptions, right? But is that a rule of thumb?
It is not a rule of thumb, but it is my strong advice in general. And again, we're trying to generalize because there are individual examples, but let's try to normalize everything. Yes, I fully subscribe to this. Go for if you're a company and you're an entrepreneur and you want to raise capital, when you're doing your CRM, who will I talk to? Focus on the ones that are specific to your stage, and there are two reasons behind it. Number one, they will give you more specific expertise for your stage, because a Series A investor cannot help a pre-seed company. Well, very few Series A investors can help pre-seed companies. This is number one. Number two, if you try to raise capital from someone who is either too small for you or who too large for you, two things can happen. Let's assume you are you're a company, you want to raise a 5 million seed round, and you go to $1 billion fund. Again, you become such a small fish in their pond. They buy optionality. They want to increase their risk profile as much as possible, because if you are successful, and this success chances is super, super slim, everything pays off. But they will push you and your risk profile to the extent that is not right for a business in the stage. And I saw this many, many times. I saw a lot of the companies over the course of this 16 years that were killed by excess capital and excess risk taking that the investors were pushing indirectly the companies to go after. How does it transpire itself? Let me give you some examples. I'm a company, I'm growing very fast, and I go there and raise a large round. For someone, large can be 20 million, for someone 30 million, for someone 50. And then I say, hire more people, launch new verticals, launch new products, increase. For some it works, for the most not. Because ultimately the pacing of how the company grows to a large extent should be determined not by the money, but what the company is ready for. And this is very important, and this is where the equation can fall apart. So yes, to what you said.
Just to sort of summarize, what you're saying is that if you bring the wrong stage investor, the result might be that they will be pushing you to do things that might not be the right things at that stage for your company, right? And then it would create risk risks for you and in your company.
Yes, and I saw this happening a lot, and I think it's a very hard mental thing for entrepreneur as well, because the entrepreneur feels, oh, they trust me, they know something, they're smart, they have seen it. Let me indeed take the risk, let me push, let me invest more. But ultimately, what happens when you do it, what you need to understand, if those bets do not play out as they did, you are still your company. But what will investors say? Thank you very much, you tried, I don't give you any more money, go raise the capital outside. How will they behave?
Yep, exactly.
Alex, but do really investors have things to push the entrepreneurs? I mean, they can advise, they can discuss, but do they have some, I don't know, maybe legal tools or something to push entrepreneurs to do things? Or is like just in the heads of the founders?
Look, generally, I think the industry, from that perspective, the industry has matured quite a bit, and I don't really see a lot of this legal things. They were, by the way, like 10 years back, this was quite common, using my rights, this is what you have to do. Not anymore. I think the industry professionalized quite a bit. But again, Arto, I think specifically with this excessive scaling, this is just such a sweet story for the entrepreneurs to hear. Yeah. So let's assume I basically come and tell you, guys, you are a similar business with Datadog. I did all the parallels. You are tracking exactly like they did. Let's go and hire 50 additional people. In most of the cases, the reality is, I do not know all the details of your company. Are you ready to hire? Are you ready to onboard? Do you understand how we need to hire? So I'm pushing the risk profile. And that's sweet for you to hear, because everyone likes to grow. Who doesn't like to grow? If you're doing a company, of course you want to grow. And so it's a very easy manipulation, I would say. And I tell you why, again, this happens in the heads of the investors, because look, if I invested in you $2 million, $5 million out of my $1 billion fund, I want to push this profile because I want you to become, I want my ownership in your company to be at least 1 billion and battle 2 or 3. This needs to be a massive company. And I will push for it, because if I lose it, well, I lost only very little percentage of my fund. But if I win, the winners will pay for everything. This is not good or bad. This is just something that entrepreneurs need to keep in mind. That when you are being given advice, you need to rationalize it. Sometimes, by the way, the advice is good. Sometimes, yes, investor can do a right momentum push on saying, "We see, let's grow more. Let's grow more."
Also, I think that from founders' perspective, look, there is always this idea that, or I mean, sometimes it's true, but usually it's not true, that money can bring growth, right? So like ads, let's say, is one of these areas, right, where you might think that, okay, like investing in ads can bring you growth, or all you needed is just like a bunch of salespeople, and you would be able to close deals. And early founders or not experienced founders have this misconception, and that's why there is, like, the advice is to always experiment with small sort of investments, make sure there is a growth engine, and then only go and double down on it, right? That's the safe path. But the point is that founders might be just, as you said, they would just get too excited to try to, let's go, and this is the opportunity. Look, this company is doing the same, it works for them. All you need is just hire these 10 salespeople, without realizing that it's extremely expensive. Usually, like, the first 10 salespeople don't work, right? So yeah, that's super interesting. Alex, maybe a bit of segue or change is what are the things like that you are looking in founders, right? Like what is that is important for you to see in founders or companies? And also just to say that I think RTP invests usually from Series A plus, right? So you guys usually don't do pre-seed investments. You very rarely do seed investments. Your sweet spot is usually Series A, correct?
Yes, we mostly try to do most of our focus today, and again, this changes depending on the specific funds and so on. But for us, we want to do Series A investments, which we for us are investments where we deploy anywhere from $6 million to $12 million initial investment, and thus the rounds can be 6 to probably 15 million. This is our sweet spot. Look, I think there are many different categories, but if I try to convert it and try to put it into advice more than anything, I do think that storytelling matters a lot. And storytelling, what I mean by that, a founder needs to be able to tell the story of his or her company in a very simple way, independent of how technical it is, so that the person listening to the story can connect the following dots. What are we talking about? I.e., what is the market? What is the current inefficiencies? Why there is an opportunity in it now? What doesn't work? What is the target state of the market that will make my company a big company? It can be either the market grows or I do a better job than my competition, or I take over the incumbents. This is the second one. And third, why we are the people who will do it. And if you can create, it's very simple, but if you create a compelling story and be able to articulate the story in a very simple way, ideally with certain factual backgrounds around the market size or the inefficiencies, this is the best thing you can do as an early stage founder to get the investor interested in it. So if out of all of the things, I would say storytelling, clarity, and the balance between the current status quo and the ambition, but creating this connection between the two, which makes people believe that this is possible and that you are the ones who can do it. Because sometimes what we see, and then what can fall, what can go wrong? Well, ambitious is not big enough. You cannot clearly articulate what's the problem and why does this exist, or you just cannot believe in this path because it's not you don't show a journey, you show the two states, and you don't really make people understand how we get from A to B. So that's what I really think a lot of the people. And then if you collect some evidences from your customer calls, from your understanding of the market that can complement each of those buckets, this is the best that you can do.
Alex, how many customers are you companies are you looking in a year as a VC partner and as a firm overall, and how many are you investing?
So our team in Europe is processing over 2,000 companies a year, i.e. the companies with whom we are talking. And those are not the ones that are coming inbound. This is the ones with whom we are talking. And this is unique number. So how many new companies do we look into? And we can invest in anywhere from 4 to 8 companies a year in kind of high level numbers.
25%?
Well, your math is better than mine, so
Okay. So it's super hard to get.
But this is the thing, yeah. I don't think this is a very relevant number. That's a good overall number, but in reality, if you look into different channels, the numbers would be very different. The chances would be 10 times or more higher if certain company is coming from a referral from your founders. The chances are 10 times higher if it is coming from some of your other investors with whom you're working. So this number is an average, but in reality, you would have sources which have much higher conversion rate. Just to finalize on this, direct outreach to VCs. If you are a founder, if you want to reach out, just forget about it. It's a waste of your time. Figure out through whom you can talk and who can connect you.
We always say that it takes 50 to 80 VCs. So you need to, as a founder, you need to meet like 50 to 80 or 100 VCs to find your VC or a single VC that will be able to like lead you around. So that's like a lot of work. But actually, the opposite from your side is also true. So you need to meet around like 100 companies to make one investment. So both, it's pretty inefficient process from both sides, I guess. But we always thought that this is a founder's problem, but apparently this is a problem as well, right?
Look, I think the market again has changed a lot. The current state of the market is, look, 2021, 2022 were just a founder market straight away. It's exaggeration, but as a founder, you just sat down and basically wait, okay, who comes in and how do I control what I give to anyone? Yeah, that was a bit too much, I think. The balance was not right. But in general, versus let's say 10 years back, there's a lot of work that VCs are doing to reach out to companies. I think the current state is that VCs need to show and front load a lot of work to prove to the entrepreneurs we can deliver value, we are the right partner for you, which was just not the case. The conversation, let me give you an anecdotal story. The anecdotal story is that even 5 or 6 years back, you can go to a call with the founder or a company, spend 2 minutes just giving him or her a background, and then get straight into, okay, let's discuss your data, boom, 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 the questions. Maybe 50% of my initial calls now are only talking about RTP and what we can do and sharing with the founders why they should be talking to us. So you see that it's a drastic difference in a way, which I think is, again, a healthy balance. A founder needs to... It's a marriage between a founder and the VC. It's a long-term project, and you need to understand both of the sides want it. That's the proper way to look into it. Of course, if you can. If you need like, oh, I just need to pay the salaries tomorrow, I don't have the money, that's obviously a very different mindset. But on later stages, it's also quite different. But on the stages of where the company is being developed from, 3 people to 100 people, or even maybe a bit more, this is super important.
Yeah, one curious question, like out of the all companies that you say no, like you basically look at the 100 companies and say yes only to 4 or 8 a year. So out of these companies that you tell no, how many of them actually convert later? Let's say, do they have even chances to prove you wrong at some point, so you invest into them? And how they can build kind of this long-term relationship with the funds they didn't invest in the companies. In our case, we had this scenario, remember, with the 0.9. They didn't invest in our seed, and then we built a relationship. So they did our extension of the seed round later on with you. So do you have any advice, like how founders can build this relationship to change the no to yes at some point?
My advice is the following. Generally, I advise the founders talking to VCs at all the time of their journey. So basically what it means, yes, there are times when you actively fundraise, i.e. you want to raise the capital for a company, but my advice is always to have a pulse on the market through consistent chats with investors throughout any time. Yeah, and it doesn't mean that you should spend a lot of time on that, but you should be doing it and keep kind of the interactions with some of them. So look at this today. Everything became pretty professional. Each of the VCs has their CRM, everything is logged, all the calls are logged, when we talked, what do we know, what information we have, when do we reach out. It's all more or less even automatic. So if one of my team members talks to a company and that's, let's say, too early for us or something, there will be an automated actions they have to perform in 6, 9, 12 months, and they will reach out and they will talk again. Yeah. So more or less, a founder should understand that they are already being put into the tracking system and they're already there. And thus, if the interaction were positive, the investor would always come back if the stage is right. Yeah. And usually investors do not cover a super narrow segment of the market. So a company would usually fit through several fundraisers that they will doing, they will fit into a given investor. And the investor will reach out and consider talking, or the founder can reach out at the time that he or she is raising and start talking to the investor. So basically answering your question, a lot of the things are automated now. By automated, I mean, when I talk to the investor as a founder, I'm put into the CRM. If the interaction was positive, they're positive about the space, about what the story I told them, there will be certain things that will happen, and more or less I don't have to bother about it. But obviously you can also activate certain proactive actions if you decide to do a raise earlier or later or whatever.
One question around this. So let's say I'm doing the round and I'm raising my seed round. Then I speak with RTP. I tell RTP that probably next year my forecast is I will get to the 5 million in ARR. You definitely put that into the CRM. And then 1 year after, you are coming back to me to have a call and update. And I'm telling you, like, I am at 1 million ARR. So what does it mean for a VC? Like, do you really care that, okay, 1 million is also good, but they told me like 5 million in my CRM, it's showing that they didn't deliver?
Look, consistency of the story is definitely something that's being tested on these calls. Yeah, and because look, let's just be very realistic. It's very hard if I meet you and we have a month period. It's very hard for me to understand how's the deal and what the investor is trying to do. He or she is trying to test. Okay, let me talk to the investors. Did they deliver on what they said that they will? And you try to test it. But the most obvious way is to have this interactions over time and trace them. So look, the answer would probably be, well, how different was my story to the one that on our first call, and what's my story today, and how different they are. Yeah, and the difference is magnitudes of time. It will be a red flag. Again, overall, in a simplified world, there are different cases. But on the other hand, if you do hit the promises, this will create a lot of excitement on the side of the investor, because then you can connect the data points that exactly are trying to answer. How's the execution capabilities of the team? So maybe reversing your question into a practical advice, when you're putting your plan into the presentation, of course you want to be ambitious, but remember that due to this logic, if it is not ambitious but unrealistic, you will have the negative effect of that moving forward.
Alex, can we talk about the business side of VCs? So you have all these investors called LPs, which put money in the fund, and then you have like partners who are managing this, right? So
Yes.
how the
So
partners get compensated, like overall how it works?
yeah, look, let me try to describe it in a very simple way. So a fund is a pot of money, a fixed pot of money. This pot of money is being collected from investors in the fund. So investors can be very different, can be individuals, can be institutional investors like the university endowments, pension funds. This is much more developed in US, where those institutions hold large amounts of capital, and they are the core providers of capital to venture capital funds. So this is a pool of money. This pool of money is given to the which we call a fund, is given for a typical period of 10 years with 2 years extension, which the team of the fund, the people who run the fund, can ask to have. So you are talking about 10 to 12 years. In 12 years, the fund is closed and all the settlements, all the financial settlements of obligations between the LPs or investors in the fund and the team should be done. Now, there is a team that runs the fund, and the teams can be very different, but there are different roles in the teams, but they're basically running the fund. To run the fund, what do they have to do? They have to find a certain number of companies that become part of that fund. But they also have to allocate the resources to further continue support these portfolio companies over the course of the journey. So the typical rule of thumb is the following: 50% of the capital that you have will go into your initial investments. 50% of the capital will go into further support of the companies that you put into the fund. So typically it works like this. The investment period where you allocate your initial capital is 3 to 4 years. So I have a fund. Let's say I started my fund and it was $100 million fund. I started it in January 2024. I have 3 years to choose the companies that will go into my fund. By this time, I will still have a lot of capital that I can put, but this capital can only be used for the companies that I allocated to my fund. Yeah? So that's a 50-50 thing. And now, how does the fund actually operate? So there is the concept called the management fee. A management fee is essentially a fee that's being, you can think about it as a budget to just run the fund, to pay the salaries, to pay the office, to run the operations of the fund. Typically, it's 2% of the fund size
per year.
Yes, if I'm a $100 million fund, I have $2 million per year that I can spend on activities outside of the investment, like salaries, offices, marketing, conferences, travel, so on and so forth. This fee usually decreases after the investment period. So after 4 years, the fee will go down. And this is basically used to run the fund. And then the core upside or the core compensation or the core financial benefits for the team of the fund is what's called carry. Carry is the proportion of the profits that the team of the fund gets. And usually it is 20%. Now, it used to be a very simple model, so 2% management fee, 20% carry. Now the model is changing. You will see 30, 35% carry. You would see that if the absolute returns are more than 3 times the invested capital, it will be higher. If it's less, then it will be lower. But for the simplicity's sake, you are having this model of 20%. And so basically, if you have a fund of 100 million, this fund returned, let's say, 300 million, then you have a profit of 200 million, and the 20% of this 200 million would go to the team. Yeah, and then it is distributed between the team members, essentially. So this is the simplified way of how things work. So what is the practically important for entrepreneurs here? For entrepreneurs, it's very important to understand and to ask the investors, what is your fund size? So how much capital do you have? Where you are in your investment period. So basically, why it is relevant? Well, it's not super relevant, but it can become relevant because if I'm at year one, if I just started a new fund, you obviously have the full 12 years that you can comfortably work with investor. If then year four, then you have 12 minus 4, only 8 years to work with investor. Why it is important? It is important because by the time that the fund closes, the fund needs to distribute the assets to the LPs. And then you never know how it will go. And there are very friendly ways where it's just being put in a separate structure. There are less friendly ways where the investors are asking actively to sell their stake. So that you don't want really to end up over there. This can be fine, but this can be a bit ugly. This is relevant, and the most important is how much capital does the fund that you work with have to further invest into your business if you perform, and so on and so forth. And I think this is quite relevant. This is more of understanding also the model of the fund. So our model is close to 50-50, so 50% initial capital, 50% follow-ons. But there are funds that have only initial capital, especially most of the pre-seeds funds. They don't have follow-on allocations. But that's important in terms of the planning. And as you're working with investor, I think it's quite important to also understand what kind of support, if any, the investor can provide to your business moving forward.
So can you become a billionaire by doing VC investments?
Yeah, look, I think there are many examples of people becoming, well, earning a lot of money into that.
No, I'm asking you
because look
about you.
I hope.
Okay.
I hope if Krisp and Podcastle would deliver
$100 million?
Big.
What Alex, just tell us.
The number I think needs to be north of $50 billion value for each of the companies. Yes.
You got it.
Look, it's possible. I think ultimately what attracts a lot of the people to this business, unlike finance, is not money. Yeah, I think I actually do not know successful investors who are driven by money. Yeah, I think all of them are driven by the passion of working with entrepreneurs and really helping them in one way or form, building their funds, and this came with the benefit of financial, the financial benefit. But look, VC is not finance, and I think it's not financial markets, it's not stock trading, it's not investment banks. Even though the influx of people from those industries is quite high in VC, but the people, I think, who made it very successful actually have absolutely no financial background. Look, they're probably one of the most well-known investors, one of the former managing partners in Sequoia, Mike Moritz, he was a journalist. So the founder of RTP, well, he was a professor, then he was an entrepreneur. So it's not the financial benefit or the financial gain that attracts the people to this industry at broad.
Cool, Alex, we are approaching the end of our usual sort of podcast time. Another question though, like how many times have you been in Yerevan?
I have been 4 times, I think. 4 great times, not 4 times, 4 great times.
What's your favorite place?
My favorite place is, look, what I try to do when I come to Yerevan, I stay in the city center, and I really like to walk. So I like to walk to Podcastle offices, or I like to walk to Krisp offices, because I go through different places. And for me, the city is just pretty very beautiful in spring, summer, and autumn when it's very green, and I enjoy it a lot.
Yeah, that's what everyone says actually. Ben was saying the same thing. Like he was really surprised and excited, just like with the fact that he can walk around the city, and it's see just people, and it's safe and everything. Yeah, that was great. All right, very cool. So any future plans to come to Yerevan, like short-term future plans?
I just returned from a great trip in Yerevan, but definitely plans are there. Look, I'm very encouraged about the potential of the ecosystem. I have enormous respect to, frankly, all the founders, independent we invest or not. I think it's a very hard work, and it takes a lot of courage to launch a business. I really believe that there is a lot of opportunity in the Armenian ecosystem to produce a lot of great companies over the course of the next years. This is predicated on obviously positive macro developments, which are quite important, but also continuing to leverage the strengths of the ecosystem, and what you guys are doing and trying to share the lessons, I think, is extremely relevant. So kudos to you there.
Awesome. Well, thanks so much, Alex, for sharing your insights, experience, and looking forward to see you here in Yerevan soon again.
Absolutely. Looking forward to seeing you again. Thank you.
And score
See
some
ya.
of the goals we did last time. All right. Take care. Bye-bye.
Cheers. Bye.